In this video, I want to show you the only profitable strategy that you need in order to succeed in Forex trading. After viewing this video, you have to forget about every other strategy and focus on this strategy because this is the most practical strategy that can help you to become successful while trading the Forex market. And that is demand and supply trading. This video will provide you an understanding of demand and supply zones and how you can trade them profitably. The demand and supply zone strategy is a strategy that relies on identifying price levels where buying and selling pressures dominate, leading to a potential market reversal. Supply refers to the quantity of a particular product available for sale at various price levels, while demand represents the quantity of an asset that buyers are willing to purchase at different price levels. Now, equilibrium occurs when the quantity supplied equals the quantity demanded at a particular price level. In Forex trading, equilibrium is dynamic state, all right, because the market prices constantly move as traders buy and sell based on the expectations of future price movement. According to the demand and supply law, if prices increases, the supply of the assets will increase and the demand of that asset would decrease. And on the other side, if the price decrease, the supply of the asset would decrease and the demand of the asset would increase. So traders use these principles of demand and supply zones, all right, to identify potential trading opportunities by looking for imbalances in the market. So by knowing how to identify a strong demand and supply zone, traders can anticipate where price will likely reverse or continue trending. So therefore, in trading, demand and supply zones represent areas on a price chart where the market has shown a strong reaction due to imbalance between the quantity of assets supplied and the quantity of the asset that is being demanded. All right. So what are demand and supply zones? A demand zone is a price area where buying pressure exceeds the selling pressure, therefore causing the price to rise. So a demand zone is a buy zone. A supply zone is, on the other hand, price area where selling pressure outweighs the buying pressure, causing the price to fall. We look to sell from a supply zone, while we look to buy from a demand zone. I want to explain to you two major types of demand and supply zone formation. The first one is the trend continuation base. So, and it is divided into two. The first one is the rally base rally demand zones and drop base drop supply zones. Now, for a rally base rally a demand zone, all right, and you also have the drop base drop supply zone. So this is a particular type of demand and supply zone formation, all right, and it is called the trend continuation demand and supply zone. All right, so you would see here, like for example, in this case, this is the USD JPY chart. All right, so in this chart right now, let us identify a demand zone, and that will be a rally base rally demand zone or a continuation demand zone. All right, so you can see here that this is the rally, in this case, base and rally demand zone. So, and this is the base. So I've shown you now. So here you can see when you extend this this zone to this point, so you discover that it presents a buying opportunity at this location. So the rally base rally demand zone, as you can see here, presents this buying opportunity and is a continuation demand zone. All right, also on the flip side, if we want to see the drop, this is a drop base drop supply zone, which is also a continuation supply zone. So you can see here, you can see the drop, the market dropped, right, consolidated, and then continued in the original direction. All right, that is why we call it continuation. The market dropped, consolidated, and continued in the drop, presenting you with a break before the continuation. And so if we extend this to this point, we are able to have a sell opportunity. All right, we're able to have a sell opportunity. in that fashion. So now, the second type of demand and supply zone formation is the trend reversal demand and supply zone. All right. The first one is the drop base rally demand zone and the rally base drop supply zone. So in this one is a trend reversal. It shows that the market is about to reverse. All right. But in the other, the first one we considered is a trend continuation zone, demand and supply zone. But this is the trend reversal demand and supply zones. All right. So the first one here, as we can see, this is drop base rally. Okay, the market dropped and now consolidated, giving us a base and now rallied up. So that presents us with a buying opportunity at this point. Also, in this case as well, the market rallied up, formed a base. A base is simply a consolidation of the market, all right, a consolidation of the market, and the market now dropped. Okay, so this shows that the market is going to reverse when the market returns to the base. Here, this shows that the market is going to reverse in the buy side when the market returns to the base. Okay, so these are reversal based demand and supply zones. You have the drop base rally demand zone and the rally base drop supply zone. Okay, so now let us look at an example of both. So you can see here in this case, this is the market dropped, consolidated here, and rallied up. So this is drop base rally demand zone. So if you extend this base to this point, you will see that when the market returned to this base, the market was able to buy from there. So you can see here that I've shown you this is a drop. The market dropped, formed the base like a brief consolidation, and rallied back up in a reversed manner, not continuation now as in the previous cases I've shown you. In the market reversed, okay, and now if you extend this, the market now really returned to the zone, to the base, and now did a buy, as you can see in this case. All right, so here as well, on the flip side, the market rallied up here, formed a brief base, and dropped here, which is like a reversal. Okay, so if you extend this to this point, the market returned back to the zone and now sold. So this is rally base drop supply zone. Okay, you can see here right now. So that presents an opportunity. So this is a reversal based supply zone because it was a rally base drop supply zone. So those are the two types of supply zones formation. You have the continuation and the reversal base zones. Okay, so let us now move. So how do you mark your zones? Okay, for a demand zone, you have to mark the distal and the proximal lines at the last bearish candle before the bullish move that created the zone. This is one important thing you need to note. And for I'm going to show you right now in the chart in no distant time. For the supply zone, you have to mark the distal and the proximal line at the last bullish candle before the bearish move that created the zone. Now let us see how that works. Now this is a GBP USD chart. All right, so you can see the market dropped here. So as the market dropped right there, so and the market formed a base and now rallied up. So this is drop base rally demand zone. So where do I mark my chart? We have to first of all identify the last candle before the rally up. So this is the last bearish candle, this one, the proximal line, and this is your distal line. All right, so you have to mark it through, all right, at the zone, at the candle. So this is my distal line, and this is my proximal line. Okay, so this is it. So you mark your proximal line and your distal line using the last candle, the last bearish candle before the move up. This is the last bearish candle, all right, before the market moved up. So that is where to mark your zone. All right, it's as simple as that. That is where to mark your zone. So you could now shade it. All right, put a rectangular block there, and now you have this. This is how to mark your zone. So I actually used the last bearish candle before the market started rallying up as the way I mark my zone. All right, so now for a bearish scenario, in this case, this is a zone. The market rallied up, formed a base and dropped. So this is the rally base drop supply zone. So how do I mark my zone? So I have to identify the last bullish candle. This is the last bullish candle that was formed before the drop, all right, that created the zone. So I have to mark my proximal line here and my distal line here. So that gives me my supply zone. Okay, several traders have different ways of marking it, but this principle, this way I've shown you now, is the most basic and simplest way, and even effective way, and the way I mark it, and I've been marking it over the years, and it has been working for me. Okay, now you can see here, so you have to identify the base, the distal line and the proximal line through the last candle, this last candle that actually occurred, that was formed before the market dropped. So that is how to mark, that is how you're going to mark it. Okay, you now put in your rectangular block, and there you go, you have your zone, you have your supply zone marked. Okay, so now how do you enter your trades? There are two ways you can enter your demand and supply zones trade. The first one is a limit or risk entry method, and the second one is the confirmation entry method. Now each of them have their advantage and disadvantage. Now the risk or limit entry method was actually first made public or made popular by a man called Sam Dearden, an American man. Okay, by Sam Dearden. All right, he's an American man, an American trader. He actually popularizes. What actually happens is that you identify your zone, and what you do is you place, like here, a sell limit entry. This is your supply zone. You place your sell limit entry in at this entrance at the proximal line. All right, and when the market, you are hoping that if the market comes in here, the market will activate your, you are hoping that the market will activate your entry here and sell. So you put your stop loss just few pips above your supply zone. All right, and you hope that the market will sell, and you go and sleep. Okay, it's also called set and forget method. But the disadvantage of it sometimes is that sometimes the market could come and you're not entering due to some entry confirmation. You're not using any entry confirmations to enter the trade, and then sometimes the market could just blast through your zone and continue to sell. Okay, so that is why traders in recent times decides to use mechanical or manual entry method. So this is for a buy scenario. This is the proximal line, and this is the distal line, and here you place your buy limit entry order at the proximal line, and then if the market, with the hope that the market will come here and now reverse to a sell, and when you put your stop loss just few pips above or below, few pips below the zone or below the distal line. Okay, but for the confirmation entry method, what happens is that you are actually looking for entry confirmation. So let me just show you how that works. Now you can see here that this is the risk entry method for both the demand and supply zones. So you can see here the risk or the limit entry method. Okay, you just place your limit. So here you place your sell limit entry here at the proximal line of your zone, and your stop loss few pips above the zone. And in this case, you place your limit entry here, your buy limit entry here, hope that the market will reverse, and place your stop loss just few pips below. All right, and I've said the disadvantage that sometimes the market could just come blast through your zone and continues to buy in this case, and sometimes the market could just blast through your zone and continue to sell, and you lose money. All right, but for the entry confirmation method, you want, as the market comes to into your zone, okay, you do not enter, you step down to lower time frame, and you are looking for a break of structure to the downside on a lower time frame, and then a return to that block to the zone that created the break of structure. So we are looking for what is called the change of characters. I've depicted it here. All right, so for the buy scenario, you want the market to come into your zone, and now you step down to lower time frame, you get your change of character, and then your return to order block that signifies your entry. The advantage of the confirmation entry method is that it gives you opportunity to confirm whether or not the market is about to sell, is going to sell, or is going to buy. All right, it gives you some form of a confirmation, and it increases your win rate. Or when you have confirmations before you enter a trade, at least, even though you may not have 100% guarantee that the trade is going to work out after the entry confirmation, but at least your win rate would improve because you are confirming that the market gives you some signs that the market is going to sell or is going to buy, as the case might be. All right, so for the limit entry method, you are placing your sell limit entry here, your stop loss right there. Your take profit will be just at this point. This is supposed to be your final take profit. The swing low would be your final take profit. All right, so you are hoping that the market will just activate your sell limit entry order and sell. Okay, so but for the entry confirmation method, once the market comes to your zone, you step down to lower time frame. Like here, this is a 30 minutes time frame, higher time frame of 30 minutes. So for lower time frame, maybe like 5 minutes time frame could be your lower time frame, or even 1 minute time frame could be your lower time frame. So you are looking actually for your break or structure to the downside on lower time frame, which we call the change of character, and now your return to order block. This signifies your entry into the trade. Okay, so on the flip side as well, this is to be your zone, your demand zone. The market comes, if it's going to be a risk entry method, you just place your buy limit entry here at the proximal line, and your stop loss will be 5 pips away from the distal line here. This is going to be your stop loss, your entry, and then your take profit will be at a swing high from where the market reversed before you came to your zone, TP. All right, so if you are to use your confirmation entry method, you allow the market to come into your zone, and this is 30 minutes time frame. So we go to a 5 minutes time frame or 1 minute time frame, and we look for your break or structure to the upside called the change of character, and then your return to that block signifies your entry into the trade. All right, so these are the two ways you can enter your trade when you trade demand and supply zones. If you're yet to subscribe to this YouTube channel, please kindly do so. And if you're finding value from this video, kindly subscribe to this YouTube channel. Give this video a thumbs up. Share with your friends, share with other traders. My goal is to help as much traders as possible to be profitable and to be successful in their trading career. Now, if you are also here to join our free Telegram community, the link to our free Telegram community is in the description box of this video. In that community, I share free setups and analysis that can help you to trade at your own discretion. Now, if you want me to take you by the hand and help you to become a profitable trader, even if you have spent 10, 15, or 50 years, or whatever how long you've spent in trading, but you have not seen profitability, I can help you. I have several of my mentees that I'm helping, and I've trained several number of mentees, and they are doing very, very well from different parts of the world. So if you want to be my mentee, I can help you. I can take you by the hand and help you to become a profitable trader. All you need to do is to contact me. My contact detail is in my free Telegram community, and the link to my free Telegram community is in the description box of this video. All right, till I come your way next time with another useful content, do have a wonderful day ahead. Bye.